Hey everyone, welcome back to Corporate Decoder. Today, US Securities and Exchange Commission just filed a certified shareholder report, and I'm seeing some interesting performance trends. Quick note, this is not financial advice, just my take on public filings for educational purposes. This report lays out how the Standpoint Multi-Asset Fund performed, and there are some clear winners and losers in their investment strategy. So what we have here is a semi-annual shareholder report from the Unified Series Trust, detailing the performance of the Standpoint Multi-Asset Fund. It covers the period from the 1st of November of last year leading up to the 30th of April of 2026. Think of this as a progress report card for the fund, showing how your money or hypothetical money has been doing. The fund has a really interesting strategy. They call it an all-weather approach, aiming to make money no matter what the economy is doing, whether it is booming, slumping, or stuck in a rut. They invest in a wide range of things: global stocks, currencies, commodities, and bonds. The goal is to offer a balance of risk and reward, and to be less dependent on just the usual stock and bond markets. Let's talk about the cost of investing. For a hypothetical $10,000 investment, the institutional class of this fund cost investors about $67 over the last 6 months. That works out to 1.24% of the investment. For the investor class, it was a little more expensive, costing about $80 or 1.49%. So while the strategy sounds complex, the actual costs for investors for this 6-month period were quite low, which is usually a good sign. Now for the big question, how did it perform? For the 6 months ending the 30th of April 2026, the institutional class of the Standpoint Multi-Asset Fund returned a really strong 17.95%. This is significantly better than their main benchmark, the Bloomberg Global Aggregate Total Return Index, which only returned 0.14% for the same period. The fund manager says their wins came from smart bets on global energy, precious metals, and some foreign stocks. On the flip side, their bets on government bonds, US stocks, natural gas, and the euro currency actually hurt their returns. It highlights how diverse their strategy is, with some bets paying off big time and others not so much. Let's look at the long-term performance. If you had invested $25,000 in the Standpoint Multi-Asset Fund's institutional class when it started in December of 2019, by April of 2026, that investment would have grown to over $52,000. That's a fantastic return. Compare that to the Bloomberg Global Aggregate Index, which would have only grown to about $26,800, and the conservative US Treasury Bill Index, which would have grown to around $29,800. This shows the fund really delivered on its promise of strong long-term returns, significantly outperforming its benchmarks. Zooming in on the average annual returns paints a similar picture. For the last 5 years, the Standpoint Multi-Asset Fund institutional class averaged a 9.65% annual return. Since its inception in December 2019, it's averaged an even more impressive 12.28% annually. Again, this blows past its benchmarks. The Bloomberg Global Aggregate Index averaged just over 1% annually since inception, and the US Treasury Bill Index averaged about 2.8%. This is a huge difference, especially over those longer periods. It shows that this fund's unique strategy has really paid off for long-term investors. Now, where did the fund put its money? As of the 30th of April 2026, about 54.3% of the fund's assets were in exchange, traded funds, or ETFs. Another 34.3% was in other assets, largely cash and receivables, which are important for smooth operations. And finally, about 11.4% was in US Treasury obligations, which are generally considered very safe investments. So while they invest in a lot of different things, a large chunk is in ETFs, which can offer diversification and lower costs. The total net assets of the fund were a massive $829,394,826. That's a huge amount of money, indicating a lot of investor confidence. The advisory fee, which is the money paid to the investment manager, was $4,078,933 for the period. It's worth noting that the portfolio turnover rate was 0%. This generally means the fund is buying and holding its investments rather than actively trading them, which can also help keep costs down. Diving deeper into the financials, we see the specific investments, for example, under exchange traded funds. They hold significant amounts in things like the iShares Core S&P 500 ETF and Vanguard S&P 500 ETF, combined with international stock ETFs. This diversification across major indexes is a key part of their strategy. They also hold a good chunk in US Treasury bills, which, as we discussed, are safe havens. The total cost of investments was over $394 million, with a fair value of over $544 million. This difference shows a healthy gain on their investments. Looking at the statement of assets and liabilities, we can see the overall financial health. Total assets were over $830 million, with a significant portion in investments and cash. Liabilities were relatively small, just over $1.3 million, leading to those net assets of nearly $829.4 million. We see things like payable to the advisor, which is the management fee they owe. The statement of operations really details where the money came from and where it went. Investment income, which includes dividends and interest, was over $6 million. But the real story here is the net realized and change in unrealized gain on investments, which was a huge positive number, over $125 million. This massive gain is what drove the net increase in assets for the period. Expenses were around $5.2 million, but importantly, the advisor waived over $536,000 in fees. That waiver shows the manager is willing to share in the cost to keep expenses down for investors. Now let's look at the per share data. For the institutional class, the net asset value per share grew from $14.58 at the start of the period to $17.07 at the end. That is a significant increase reflecting the strong performance we saw earlier. The total return for this 6-month period was 17.95%. The ratio of net expenses to average net assets was 1.24%, which is consistent with the cost we discussed earlier. The notes to the financial statements provide crucial context. For instance, the Standpoint Multi-Asset Fund is a series of unified series trust. The fund's advisor is Standpoint Asset Management, LLC. They follow accounting rules set by the Financial Accounting Standards Board, or ASASB. They also mention they are a regulated investment company, or RIC, which typically means they distribute most of their taxable income to shareholders. An interesting point is that the fund consolidates its wholly owned subsidiary, Standpoint Multi-Asset Cayman Fund Limited. This is common for funds looking to operate in different jurisdictions or hold certain types of investments. The Cayman subsidiary owned about 19.94% of the fund's net assets, which is a notable portion. The fund values its investments at fair value, which is the price they would get if they sold them on the open market. They use a hierarchy to classify these valuations based on how observable the inputs are. Most of their investments, like the ETFs and US Treasury bills, are classified as level 1, meaning they are valued using unadjusted quoted prices in active markets. This shows a high degree of transparency in their valuation process. We also see a detailed breakdown of their derivative transactions, which primarily involve futures contracts. They use these for hedging and to gain market exposure. The report shows substantial positions in both long and short futures contracts across commodities, currencies, equities, and interest rates. For example, they have large long positions in commodity futures like Brent crude oil and light sweet crude oil, and also significant short positions in interest rate futures like the Euro Bund 10-year future. The net realized gain on futures contracts for the period was over $66 million, and the change in unrealized appreciation was over $27 million. This indicates their trading strategy in derivatives was a major contributor to their overall positive performance. The management fee is 1.24% of average daily net assets. For the period before any waivers, the advisor earned over $4.6 million. However, the advisor also waived over $536,000 of these fees, which is a good sign for investors as it reduces the overall expense ratio. There is also a note about potential recoupment of these waived fees in the future, which is standard practice. The report also includes a discussion about the renewal of the investment advisory agreement. The trustees reviewed the fund's performance, services provided by the advisor, fee rates, and profitability. While the fund underperformed its benchmarks over the 1-year and 3-year periods, it significantly outperformed over the 5-year and since inception periods. The trustees acknowledged that the higher fees for the fund were partly due to its complex futures trading strategy. They ultimately concluded that the fees were not unreasonable and renewed the agreement. So, what is my take on all of this? The Standpoint Multi-Asset Fund has delivered truly exceptional long-term returns, significantly outperforming its benchmarks. Their all-weather strategy, utilizing a diverse mix of assets, including a substantial futures trading component, appears to have been very successful over the long haul. The recent performance is strong, and the costs are competitive, especially with the advisor's fee waivers. The biggest strength here is that long-term track record and the fund's ability to generate absolute returns, which is a valuable objective for any investor. The risks are inherent in the complex derivative strategy, while it paid off handsomely recently. Futures trading can be volatile, and past performance, as always, is not a guarantee of future results. The slight underperformance in shorter timeframes compared to benchmarks, though, shows that this strategy doesn't always win in the short term. My biggest concern is similar to what the trustees noted: the complexity of the strategy. While it is working now, understanding and predicting its future performance in various market conditions will always require close attention. What I am actually looking for is how this fund navigates periods where trend-following strategies might not be in favor, as the report mentioned. Alright, that is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Oh, and the research tools I actually use are linked in the description. They help keep this channel going.